Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Welcome to today's video. We're going to break this topic down in a simple and easy way so you can follow along without any confusion. Let's get started. Criminal scammers and reckless advisors promise incredible financial benefits, but these promises always lead to trouble. These schemes are not creative tax planning. They are high-risk financial avoidance maneuvers that can result in massive penalties, audits, and criminal charges. Secret offshore bank accounts that promise no reporting. If someone encourages you to open a bank account in a tax haven with the promise that the bank will never report your details to your home country, run the other way. This is one of the oldest schemes, and it is completely unreliable now. CRS and FATCA have closed these loopholes. The danger is not just the back taxes you might owe. The penalties for failing to report foreign accounts can be enormous. Penalties can sometimes be based on the size of the unreported account itself, and willfully failing to report can lead to significant fines and potential prosecution. Fake shell companies used to hide your name and income. A shell company is essentially a corporate structure that exists mainly on paper, often in a jurisdiction with low taxes. Promoters sell these schemes by setting up an offshore company that appears to hold your assets, making it look like the company owns the money, not you. They promise this structure hides your identity. The reality is tax agencies see through this quickly. If you control the company, direct its actions, and use its resources, they will treat you as the beneficial owner. Furthermore, many countries, including the US and EU members, have enacted beneficial ownership registries. These public or semi-public databases require disclosures of who really owns and controls these shells, making it easy to pierce the veil of secrecy. Offshore insurance wrappers and fake investment bonds. These products appear complex and sophisticated. Promoters sell them as special offshore life insurance policies or investment bonds that supposedly convert taxable income into tax-free growth or delay taxation indefinitely. They often come with high upfront fees. While legitimate, heavily regulated offshore insurance products exist, these scams twist the rules. The problem arises when the primary purpose is not insurance but the systematic evasion of taxes by disguising routine investment income. Tax authorities are aware of these schemes. They often reclassify the income, demand payment of all back taxes, and apply hefty underreporting penalties. Many investors find the high fees and long lockup periods are painful even before the tax agency gets involved. Crypto mixers and offshore exchanges used to dodge taxes. Given the global popularity of digital assets, some investors think moving money into offshore cryptocurrency exchanges or using cryptocurrency mixing services will erase their transactional history and hide gains from tax authorities. By 2025, this strategy is extremely risky. Most major countries treat crypto assets as property or income subject to capital gains tax. Regulators are actively working with exchanges to share customer data. Moreover, government investigators and private firms use sophisticated blockchain analysis to trace transactions, often making it possible to track funds that went through mixers. Trying to dodge taxes on crypto gains this way is likely to lead to an audit. Citizenship by investment programs sold as tax escape hatches. Some people purchase a second passport or residency through legitimate citizenship by investment programs. These programs can offer useful travel or residency benefits. The scam happens when promoters promise that by simply buying a passport, you can instantly stop paying taxes in your home country, regardless of where you actually live, work, or maintain family ties. Tax residency is not based on your passport, but typically relies on criteria like how many days you spend in a country, where your primary home is located, and where your professional or personal ties exist. Moving assets offshore and keeping a new passport while continuing to live and work primarily in your home country will not allow you to escape taxation. This fake move can easily trigger costly audits or a complex scenario where you face being taxed in two countries at once. Thanks for watching Part 1. I hope you learned something helpful today. Don't forget to like, share, and subscribe, and stay tuned for Part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.